once in a while, the markets do something so stupid that they take your breath away. With that as the theme, welcome to a Zoom web series hosted by One Tree Hill and PMS Cart on the Juggernauts, conversations with uncommon and curious fund managers. Hi everyone, my name is Jai and I have with me today Manish Bhandari from Vallum Capital. Manish runs one of India's highly rated PMSs, has close to 2 decades of experience in the capital markets, ranging from obviously Vallum right now to ING and HDFC Security. So we are very glad to have him. Welcome Manish to the Juggernauts.
Very good morning, Jay. Very good morning.
If you're ready, one of the things that we like to sort of dive into is what we call the machine gun 15. Right? It's a quick fire round of questions that will, probably make you think twice before answering, and hopefully you don't. But we are hoping it's as much fun for you as much it is for us. So if you're ready, I'll begin.
Sure, looking forward to it. As a PMS manager and as an investment manager, we see a lot of bullets coming on. So maybe let's this time let me try.
Anyway. Super. Okay, so simplicity or diversity?
Diversity.
Okay. Is the stimulus offered by the government good, bad, or ugly? Now that we've had enough time to look at it, dissect it, etc.
I would say good.
Okay. Outside of India, there seems to be a big push or a big move towards sort of big tech. Will India ever catch up to this? And maybe now you're in Reliance.
Yeah, but Reliance is it's data, not more versus tech, but maybe at the fag end of our careers.
Okay. Excellent. The question on everybody's mind right now, what is driving the market upwards? Seemingly sort of ignoring the state on the ground. Are we seeing some buying panic?
Yeah, definitely. Dopamine, people do want to satisfy dopamine, which is with the instant gratification. And so the fear of missing out is there, which represents the wider range of the rally. But it is the expectation of the normal living with the COVID over a period of time, which this market is reflecting. And also the expectation of the liquidity, which has been released in the global markets and finally find its way into the various asset classes. These two things which is leading this driving up the market.
Okay, and do you think that liquidity has a long way to go, or will it stop at some point?
It's really difficult to say because if you look at the Fed action and liquidity, two providers of the global liquidity, three of them. One is Federal Reserve as a reserve bank currency to the world, and then it's ECB, and the third one is Japanese Central Bank. And if you add the two which has mattered most in the last half a decade or so is Federal Reserve and ECB, and if you add up both things together, then maybe we haven't seen any sign yet where we can see that liquidity is going away. In fact, close to 2 trillion has been added by Federal Reserve in the last 3 months. And if you look at on a decade or so, it is that the Federal Reserve balance sheet has expanded by 7 times in a decade. And ECB is also up by close to 50%. So it is there. It's not so easy to withdraw liquidity. And we have been seeing, and there's enough noise which has been there around the repercussions. But we are yet to see about the withdrawal of the liquidity.
Which balance sheet with the Indian context do you think is the most stretched? Is it the government, corporate, or the individual?
The government has maybe over the course of our conversation, I will tell you about our reflection of this crisis and how government is dealing with this crisis. I don't think so. At the moment, it looks like the government balance sheet is stretched, but the government by design has not released so much of money. That's just 1.5% or 1% or 1.5% of the GDP as an stimulus till now. So maybe as you see the numbers of the GST collections coming back, then we'll see the repairment of the government balance sheet in the due process. So it's a COVID situation which one has to monitor, and maybe 70-80% of the India is out of the lockdown and getting to normalization. So the government balance sheet will get repaired over a period of time. I don't think so. And even the corporate balance sheet, if you have to look at it, it is the deleveraging process which is started maybe 5 years back after the Raghuram started AQR and all many of the things on the central bank side, which has pushed the deleveraging process. And what we are seeing is the accelerated path of the deleveraging which has happened in the course of the action. it is the individuals who are getting re-levered at this point of time.
Okay.
And so I would be worried some on the individual side versus the corporate and the government side.
Okay. A good time to sort of get into debt funds.
Oh yes, yeah. What you have asked me is today the spread expansion between the AAA rated and the single A rated. And mind you, for the credit rating agency, whom would you trust? That would be my caution, the word of caution. I think so. It's a once in a half a decade opportunity, or maybe once in a decade opportunity, where the spread compression would happen, as you see going forward after maybe a 6 months or a year's time frame, when the risk aversion will go to normalization. So there is a lot of money which you could make by selectively buying the debt papers, and also it fits into the contrarian theory of where the capital is leaving this the credit risk fund at this point of time. And usually that's an indicator for someone who's smart enough to push his money in this kind.
Absolutely. Absolutely. And sort of, talking about credit, obviously one of the sectors which has been in focus, and I know you guys look at it quite closely. Uh, is the NBFC problem as difficult as it looks?
Obviously you need to bifurcate between the NBFCs. All NBFCs are not one. You can't one can't use the nomenclature NBFC to paint everyone. A wholesale NBFC versus a retail NBFC versus a housing finance NBFC versus NBFC of a loan against shares, and so they come in different varieties. So it's like a cat family from cat to lion, and you may put them into one same family bracket, which is not the case. So if you are talking about a wholesale funded NBFC, I will be worried about, because your trade exposures are quite lumpy in nature. And in this kind of circumstances, it will be difficult and it's going to be a very difficult sale through. If you are looking for microfinance companies or NBFC who are into some variety, or housing finance companies, you may have some temporary disruptions, moratorium, which is on the temporary side, but I don't think so that is something which has to do with long-term business viability of, unless until you have a solvency crisis because you have lent it to the wrong set of people, and that is those cases would need to find their own way to survive through. But as a pack, I don't think so. Maybe after 3 months, 6 months, as a normalization would happen, we will see many of these guys will say through it.
So maybe even like a gold financing company is maybe something to start looking at.
Maybe you are late now at the moment, because they are one of the best performing NBFCs, the gold financing, because suddenly the world has realized that the asset doesn't have a problem, and asset is gold, and suddenly the people have woken up that gold is interesting and it shines well. Right. So they have done well, and there's nothing to worry on the gold NBFCs. But yes, the market did paint many of these NBFCs in the same brush. And suddenly, when you have one of the finest gold lending company which says that there's no moratorium to offer to their customers, and it's quite surprising to the investors. But that's true that not all of them are.
Super. What is the next oil? Is it data or is it pharma or something else in your mind?
It's so easy to draw parallels but yeah, data is because we have yet not geared up to the power of data, because in our daily lives, in very, very small way, we are yet to see data companies. We are yet to see the what data can do in our life in very meaningful way. What we have had is imported technologies, Alexas of the world, and maybe Googles of the world, but an average Indian to come to a full harness the power of data is still yet to come, and that's the reason what you see today in Reliance and in many of the companies about the data. And this has already happened in the western part of the world, and this will happen in India also. So obviously, data collection is a very important aspect in the Indian context. And yeah, as you mentioned about pharmaceuticals, one industry I'm very hopeful in the long run that it truly delivers competitive advantage to the Indian companies, to the Indian economy, as well as to the global market, is the chemistry skills of India and the pharmaceuticals of industry of India, and they will also do very well.
Okay, super. We're almost coming to the end of this. Just a couple more questions. Would you go for a passive or an active part sort of on your portfolio, or somewhere in between?
No, as an investment manager, we are an active manager. So I can't rattle my brains and say how we could go passive. I mean to say, if you mean going passive means to buy or hug the index, so then maybe my answer to you would be that every manager, including ourselves, should be petrified of a long period of underperformance to indices,
Sure.
and there won't be any rationale for any of the fund management houses to exist if they have consistent or maybe an extended period of underperformance to indices, and which has happened in the US markets, and it has led to the emergence of hedge funds, and maybe PMS will do far better jobs in India, and guys
Sure.
like you will be a torchbearer in this process. But yeah, it has to be an active management. And what I see a situation is that where you the bets has to be far more concentrated in nature to make that active management work, and that would produce you a volatility of returns, and which an investor has to bear in mind that you are dealing with a active management with the concentration of bets, and obviously they will not work in all seasons, but over a period of
Sure.
time it will work. That's where the journey of the active management would end.
Okay. And one aspect that nobody knows about you, not even maybe Madhu.
I don't know. You want me to share a lot of details, right? One aspect. Okay, let me tell you from the professional angle point of view. Long back when we started our PMS, we realized that some styles have worked and some styles have not worked, and each time and each it's an ever going, as an ever realization and introspection. We do look at it that what styles and what things would work. There are edges which were working in 1990s. You met the management, you get excited about, and you have an edge in meeting those management. Then you have an annual reports which were very glossy one, and you have an edge over there. So over a period of time, those edges have waned away, and there are new edges which are coming in. So what we do at Vallum is that we spend a lot of time in blending the top down and the bottom up. And I believe so that a lot of people do say that it's an only bottom up approach would work and nothing else would work. And I would disagree. I think it's a blend of top down and bottom up. So we spend a lot of time. I personally spend a lot of time in understanding and reading and very diverse subjects. And this helps us in keeping us our edges slightly sharper in the business. And that's what maybe I could say. So.
Okay, just one point I'll add out here. We've put out 14 of these episodes with different people like you, and you're probably the first person to say that. Look, we use a blend of top down and bottom up.
Oh
So
yeah, I'm thumping the table, and I want to, since your show is viewed by many people who are starting their career, that years and years the bottom up has worked. The bottom ups will be taken away by the screening processes, and you can screen it very fast, so the edges will change. So each
right,
cycle of the market, I've been in the market for 20 years, and what I started with. And maybe at the end of 2008, those edges were not working, and you have to reinvent yourself from it. So the behavioral edges has remained over a period of time, but
sure.
how do you read those behavioral edges keep on changing? So I can see if I have to bet things, I would be very wary of putting in just the bottom of processes. It is going to be apart from behavioral edges, it has to be a top down and the bottom of combination, which will work well in the fund management, active fund management.
Okay, fair, fair. Great. So we're at the end of this. I'm happy to say, your hamper will reach you, as soon as this sort of lockdown unlocks properly. And as soon as, people start to do business, at least in Bombay, where I think you're based out of. But where do you see us progressing now that, the unlock has started in a manner? And you also mentioned 70-80% of India is sort of, opening up to a good degree. But specifically, in cities like Delhi, Bombay, Chennai, etc., where we are still very unclear, there still seems to be a good amount of um, uh, panic, so as to say, as to where this is headed. Where do you see, from an investing point of view, does it affect anything?
It does affect psychologically because you are sitting in heart of Bombay, and one would debate it as a failure of governance. There was enough time in the lockdown to prepare ourselves, but how would you prepare yourself? So there is a philosophical angle to it. that how much you would have prepared for it for a 1 lakh cases, for 10 lakh cases, for 20 lakh cases, and that number keeps on changing. So obviously it will be a situation of dire consequences for a long period of time. And this is something which none of us have got any idea about when we started off with 5,000 cases in India, and today the number is growing leap and bounds. So I would say that it's so difficult for us to say, because there are enough noise which talks about a second wave, and there's enough noise which talks about a herd immunity. And I think there are some 10, 15 times the horse cry about the vaccine arrival has happened. And the Bill Gates have said categorically that it's going to be a year's time frame before you can see the vaccine. So what you do in that intermediate period? So it's a chaos. It's a chaos at its best. And the best thing is to have all the precautions of what you can do. If you can work from home, please do work from home. So
Sure.
I see a situation where it'll be more chaotic before it peters down. And that only it can peter down by the herd immunity. There's no other reason how we can see this crisis solving.
Sure, sure, sure. And sort of now, moving on to Vallum, which you guys have been running for a good amount of years and decades, more than a decade, I believe. Uh, you guys have done really well. I believe in the last 5 years, an outperformance of close to 6-7%. Uh, Although there might have been a bit of volatility, but at the end of the day, Manish, the question that I would like to ask is, what has been that edge that made you sort of stick to your philosophy, as you said, make a few adjustments or continuously try and innovate yourselves, and has made you successful sort of over the past decade?
Yeah, so it's a shade less than a decade now. We started in October 2011 and our NAV has grown to, by end of May, to a compounded average of 21-22% despite the drawdowns in the mid caps. So for a decade or so versus an index of 7 or 8% or so.
Sure.
So what I'm more interested in was the Sharpe ratio, which is close to 0.70 versus index of 0.11, 0.70. So I would say that that's a test for us. Can you have a higher, better Sharpe ratios or not? And what has worked in this process, as I said, that we realize that the edges keeps on changing fast, and you have to be very careful about those edges. And also our temperament. It's not just me; it's Madhu and my team. Everyone put together are a bit contrary in nature in terms of our putting up our reflexes to market. And that also helps us in sometimes avoiding the reflexivity, which has been the momentum or the reflexivity. So what does a reflexivity mean for a common man? That if the earning expands and the earning momentum happens in a company, the P keeps on expanding. So you have a journey of earning expansion and a P expansion, and one fine day when it peters out, the both falls. So it's Humpty Dumpty fall which happens, and this happened in many companies, large cap companies. You saw the Bajaj Finance of the world, and you saw the Eicher Motors of the world. All those companies are wonderful companies and wonderful, valuable companies. And but you have the reflexivity which went on for long in the process. So the operating leverage got played out in the process. So now you see the contraction of the reverse effect, which has not been well understood by the participants and the market players. And we do pay a lot of attention in these areas. That finally you may have a situation where you land up in these kind of reflexivity. The second thing is that we have been contrary in nature. So last year when we moved into pharmaceuticals, which became a good part of our portfolio, if you look at what market was pricing in was 8.5 lakh crore for the whole pharma industry versus Hindustan Lever for 5 lakh crores and not 6 lakh crores. So you have this kind of a disconnect which keeps on happening in the market. And when you look at a broader picture, you will be able to figure out that is this industry so bad that it doesn't deliver a value for the whole industry, and it's a global industry. So these kind of discrepancies do help you in putting up the trades and the long-term trades together. So as I said, when you combine this and you keep on evaluating the edges which will be working over a period of time and which constantly push you to set up a new limits. It doesn't help when we invested in a gold loan company last year. Can you imagine the gold from 2012 when it peaked out at $1,900? It was a level at $1,300, and people said, "Oh, that this is an asset which doesn't move." So people like something which moves, and we don't
Themselves.
which moves too fast.
Absolutely, absolutely. No, 100%, 100%. And as I said, we've seen generally, and one of our guests had also mentioned it. People tend to sort of, give their own judgment out, but tend to follow the expert of that particular time. And we know those experts, change from every year to almost every year, because one theme has worked, or one factor has worked, or some slice of risk has played out even more. No, completely agree with that. While this is true, Manish, one of the things that investors obviously always want to know is that, we as fund managers, as advisors, give think that look, now is a great time to enter India, right? But what generally people don't talk about is that how do you guys actually land up exiting a stock, or how do I exit a PMS even maybe?
So if you so what has happened in Indian market is that the market got played out in cycles and cycles. So you have good cycles and bad cycles. So a lot of people today do forget, which I keep on telling everyone and our clients also, that there are periods between 2009 to 2014 where BSE index gave you just 1% return on those 4 years, and the mid cap index was down 9%. I'm talking about index. The composition of index would have changed. So you have an extended period where some company, the collection of companies may not make as an economy, may not make so would this be a time to invest, or would it be a time to divest as an investor? Then maybe it depend upon what is your horizon. So what you need to do is, what is a broader theme, what is required is an asset allocation. So maybe there is an inherent bias for everyone. All of us who are sitting on this side of the table, including yourself, is to keep on saying that the buy equities and all the buy. And therefore, there's a disenchantment for the investors on the other side of the table who are seeing CNBC and ET now for some free doles and free lunches, which Adam Smith said long back there's none. That how do you get into it and how do you get out? So you have a incentive, which is for the asset manager to gather more and more assets. So there's no incentive for him to tell exit, exit, exit at this point of time. So here, who has an incentive to tell you exit equity at that point of time? And that would be the people who are doing an asset allocation. And those guys who are doing an asset allocation would be a right framework to tell you to invest in debt and invest in gold or invest in equities at this point of time, or maybe a foreign equity, or maybe XYZ indices or XYZ markets. It would be very difficult for an asset manager to tell you exit the business at this point of time. So what you need to do is just look at the dock which are not barking at that point of time, as Sherlock Holmes told in one of the
Okay, okay,
so that is where I think the bigger point is for us. When you, as you said, that how when you see for us to exit in a stock, exiting a asset class is far different from exiting a stock. And exiting a stock for us, as I said, is that we are fearful of the reflexivity which gets played out on the one side when there's too much of momentum and the fundamentals are running quite ahead, the valuations are running quite ahead of the fundamental. And someone wants to pay a 3 year forward earnings, a 3 year forward, and is able to discount. It's an art. It's an art. And if someone is able to, if the market aggregate is discounting, that the situation will be far rosy for extended period of time, which happened with the NBFCs, non-banking finance companies. They had most of the NBFCs had a huge reflection trade because of the rising property prices versus the expansion of the volume growth. And
sure.
in that context, it was a perfect trade for you to not to, I mean to say, they're holding NBFC to exit a housing finance company, or maybe to trim down your position, or maybe at least not to buy those companies.
And you guys did that, I believe.
Yeah, we have stayed away from NBFC for considerable came because of our learning when we wrote about a report of the demise of the housing prices in India, and that was in 2013. We were slightly ahead of the cycle, but we saw that coming because everyone in India was making sure that they are dabbling into housing prices, and now we are in 2020, and in nominal terms, you are down close to 65-70% if you bought a house in 2013, 14 at those peak prices. So that is how a capital destruction would happen.
Sure, sure. And sort of talking of capital destruction, I'm sure over your period as well, and sort of the 15 years that I've been in the markets, we've given a lot of tuition fees, right? In terms of learning, right? Saying that, look, after 10 days realizing, or maybe after 2 months, like, what the hell did I just do? What has been that one maybe learning or one big mistake sort of in your career where you said that, look, I've given a significant amount of tuition fees to the market, but came out on the better side with a good amount of learning?
No, tuition fees is a tuition fees, and everyone has to pay. So you can't escape from a tuition fees. And if there is any escapement, I'm not too sure. So
Sure.
everyone does pay it, and how much you pay it can be, you can take an online course from Harvard, or you can be on the campus of Harvard. There is a various way, and you can be part of those WhatsApp group, or you can read HBR also. So
Right.
there is a different way of paying a tuition fees, and we do pay our own tuition fees based on our mistakes at that point of time, and we have paid enough. It's not just about the companies which have gone wrong in our assessment. Sometimes micro companies have not worked to the satisfaction. We paid a lot of attention to the change in the management, and those change in the management didn't fructify the way it is. It has also happened with me personally, where I have bought a stock which is contrary to my style, and I have sold at a marginal loss, maybe at a break-even price, and the stock has done very well. And I'm still figuring out that. But yeah, there was something which was bothering me for some time. That I also tried. Maybe let me try momentum. Maybe I'm missing out something,
Sure.
and and didn't play it out. Maybe it was not for me. So there are various way of understanding a market, and it is a wonderful learning machine. It's a wonderful learning machine.
Okay, fantastic. And on taking the opposite side, where has that been one opportunity, maybe that what was quite sort of obvious to you, and the market probably did not see it as clearly as you did?
Maybe I can refer to last 18 months or 24 months. It has been very challenging, but something which did well in last 24 months. And first, let me admit that when you see an opportunity, no one can make a prediction on a piece of paper and says, "Oh, this will be going to my exit price, and this is what is finally I would land up at." A lot of things happen during the way, and life happens to you during the way. So what you see is at that point of time is what is a margin of safety in this, and does it fit in my core belief of investing or not. And when we invested in, and we spoke about very loudly about in our shareholder letter, which we write very detailed on once a year or so, about the gold companies. And we were looking at on the financial side, which are the set of companies which can do well and which doesn't have any problem on the asset side, and also on the asset liability mismanagements, which was very contrary to the housing finance companies or many wholesale companies. And we found the golding companies. And when I see back, when I look back, you have a situation where the gold finance companies, the gold at a historic low, what you're talking about is a gold, and you keep on reminding, I mean, it's a gold. So I'm missing, or maybe it's not gold. No, it's a gold. So it's a gold where a gold is at a historic low relative to the markets, relative to the other asset classes it is. And you have a gold loan companies which have survived for 30, 40 years and maybe 100 years vintages. And in that context, they are available to you at a one-time price to book, 1.25 times price to book. And certainly when the market turns, those companies become very valuable. So for me, it will be injustice to tell me that to tell you that I did saw that iceberg coming for the other portion of the market. Answer is no. We found a good opportunity, and we should make some money out of this, and where our asset and balance sheet should be protected well enough. And in that context, you are putting up a trade, not just because you can see something correspondingly coming in. And same was the case in the pharmaceutical. When I see the value what pharmaceutical delivers, you have a peak of pessimism. US FDA will come to each of us at our home and will ask us, "Oh my God, you are eating a pharmaceutical of this company." And that was the level of pessimism which was built in the pharmaceuticals. That industry aggregately adds a lot more value. And in that context, it was very underappreciated versus the other relative opportunities in the market.
Okay, super. Uh, you mentioned at some point, the markets are in, will be in the cycles. It's impossible to sort of, get in and get out at the right time per se. Uh, let's assume we are in a cycle which, a lot of people are hurting. As you mentioned, individuals per se are the stocks that we have in our portfolios. how do you control sort of your emotional quotient and not give in to momentum, let's call it, right? Which is, when
Let me admit, oh sure, let me admit, I left institutional money management in an institutional format in a mutual fund as a mutual fund manager way back in 2009. And when I started, I set up Vallum, and I did wrote what are pluses and what are minuses. And man of a meager saving, I had a lot of worries at that point of time on starting on my own. And at that point of time, I must remind you that the market doesn't used to move for 4 years. Market doesn't move, and if you have to say someone that this equity investing, and it was a slightly abused word for that short period of time. And in that context, once you write down these pluses and minuses, I did figure out that what doesn't fit in my area of interest is the reflexivity and the momentum, where there's a huge chase or the consensus build out has happened.
Right.
So when you write down these things, what gives you comfort, what doesn't give you comfort, and what has worked for you, over a period of time, when you test this theory in the market by investing, you do get a reinforcement of those things. So what has worked for us is our own philosophy of slightly being contrary in nature. Look at the whole business cycle. Just don't look at so in our process of maybe our whole evolution journey, we have kept maybe 60% of our stocks for more than 3 years, 4 years or so, and which is a good metric. So I could safely claim the portfolio turnover ratios would be one of the lowest decile, lowest quartile, I would say, versus other middle market companies. And that is a good reflection for us that you are doing something which, and you are able to stay around in that for a pretty long period of time. And sometimes it works other ways around also. But over a period of time, holistically, it would help. It would help you to put slightly more contrary in nature and look at where is a consensus which has been built and which is where is a non-consensus which is. And look at in front of you. It's a pharmaceutical sector exactly 18 months back. It is a Reliance Industries exactly 18 months back. And today it is a consensus, and exactly 18 months back it was not a consensus. So
Right.
life changes very fast.
No, that's where I think obviously you guys do well. And Manish, so we almost reached to the end of this conversation. One of the questions, and this is more to do with people who are sort of just starting off, either taking on client money, maybe starting off their careers in fund management, and maybe sort of maybe even started off in the past sort of 6 months. And obviously, it's been a roller coaster ride for them. With your sort of decades of experience, and I understand, you can't compress 20 years of experience into 5 statements. But what would you tell them to do right now if they've sort of just started off in the last 6-7 months?
Good question, because you are asking me what I've learned over these years for maybe. So I'm slightly unique because I did 5 years of stint as a sell side initial part of my career, another 6 years as a professional money manager with ING, handling their insurance portfolio and the mutual fund, three various schemes, and now I shared less than a decade of managing as an entrepreneur. So what I would say is that be very firm with your style, which is very important, because you can't. In money management business, you have a problem because some style doesn't work at some cycles, and that is the truth of a style. It will work in some cycle, it will not work in a cycle. So how would you, when you are likely or you are expected to give an even return, a linear returns, can you give a linear return? Answer is no. So first thing is an acceptance of a fact that none of us can give you a linear return each day compounding. Answer is no. The style will work, the style will not work, and you have to be true to your style. And so is the case with many of the investors across the world, and there are fashions where they have been out of fashion for a long period of time. So one, you have to recognize your style, that what is your style, and be true to your style. And second thing is, I would say that is the client communication. I personally experience many times we have this debate internally that we should write more often. We should tell client this is happening, that is happening. And I said, just look at the book called Ground Rules by Warren Buffett. And when I start off my career, when I look at that book, and he said that I chose just to write once a year. And I'll be very truthful in my conversation when I write you once a year. So that's not what I'm advocating, but what I'm saying is that you have to be very clear what you want to communicate to your clients. All clients may not be made be for you. There'll be few, and you just need some few pockets of clients who will be for you and who will identify themselves with your style of investing, and that is very important. So usually in a mutual fund format, it is welcome everyone, one come all, and which may not be the case in the PMS business or the AIF business. So you have to demarcate what set of clients you want to, and that means it brings you to a very difficult journey, very difficult path. It's no easy path, and so it is. And the third thing is I've learned in a hard way is the use of technology. And use as well. You don't need to have a bigger teams. You don't need to worry about. So when I started off, I was reminded again and again that how you fight against the people who have a battery of 70 analysts inside, outside, and the best of the brains, and was where we would have a disadvantage in the process. And I would say that over a period of time, we have overcome that disadvantage by putting our own efforts, by empowering our team, being a small team, and a lot more putting up the behavioral edges together in the process. So I would say that you don't need a strong team, and don't be fearful about that mutual fund have got a battery of people, maybe a cottage industry of 200, 300 people supporting
Got
individual fund houses. So that brings me to a point that SEBI should implement a MiFID, and which will give a level playing field to everyone, and it will be a wonderful saving for the investors also in the process. So
okay.
I would say that the road is paved with good intention. Road should be paved with a good intention, and for the smart people, there is a long way to go.
Okay, superb. Manish, this has been fun for me. Hopefully, you enjoyed as well. Uh,
Thank you. You have been very gracious and generous with your words.
I'm saying I have to be with all good performing fund managers.
so, this brings to me another point. There is no good performing or a bad performing
No,
fund
no, yeah,
manager.
absolutely.
What
And,
you need to, so you guys like you need to segregate the style, and maybe what is expected is that you need to provide to the clients as a platform that what style, what is individual style, and people have to identify with those styles and say, okay, this is a style that work for me. I have enough of this style and I want to add this style. So I think the style of investing becomes far more powerful statement versus a good. So you have a Warren Buffett has underperformed for a considerable period of time, and that from the last music he gave about the gold has done well. So whether can be all question about his judgment, answer is no. It is a style which has not worked for a considerable period of time, and when it works, then he comes emerges as a winner. So I would
absolutely.
say everyone is good. Everyone is good.
No, no, and that is the key. That what is going to be driving the alpha rather than how that alpha has come
Yeah.
or in the past, and to identify each fund manager and try and dissect performance or alpha.
I would say that a fund management business, as I look back, is of a constant source of misery, because if you are too early, although you bought a reliance and it didn't work for you for a year or so, and you have a big position in that, it added to your misery. And now you have a reliance, so it has taken you, maybe despite having a good stock, it took you 1 year of misery for its performance. So the business persistently is a business of misery.
No, no, absolutely, and and that is something that all of us have to take back, reflect, and try and implement to a good degree. But great, Manish, thank you for your time.
Such
Uh,
a pleasure.
here's wishing you and your team at Vallum and Madhu a great 2020 years. Wishing you a good amount of more consistent alpha over the next decade for sure. And again, thank you so much for your time.
Such a pleasure. Thank you.